Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, everybody, welcome to another amazing episode. So today I have a very unique treat for everybody. I have here Rob Beardsley, and not only is he on the acquisition side underwriting deals, but he's actually a founder and a principal of a company called Lone Star Capital, right? And so they've purchased over $100 million in assets, predominantly in Texas. He also is the host of a podcast that focuses on institutional investors. So here's why I'm very excited about this conversation. It's one thing to talk to people who are participating in this business, okay? It's another to talk to someone that's actually participating as an underwriter and also as an investor, right? So this is going to be fun. He also wrote a book called The Definitive Guide to Underwriting Multifamily. So without further ado, Rob Beardsley, welcome to the show, man.
Thanks for having me on.
You're very welcome. Hey, so I'm excited to have this conversation, but I'm going to now just talk a little bit about your background, okay? Just so that I can invite our audience into this conversation. So I know I've shared with him your background about acquisitions. You've acquired over $100 million of multifamily real estate. You've probably underwritten 3, maybe 4 times that amount. You love to write. You've written about 40 different articles on underwriting, on deal structure, on capital markets. And you also host a podcast that's specific to institutional investors. So here's the big question, right? Is why underwriting? Why underwriting? Why did you make that your focus?
Yeah, so I grew up really enjoying the analytical side of things. It's funny because growing up, I hated writing and I thought anything qualitative was stupid. I hated gray areas. I loved math where things were black and white and I could just follow the formula and know I got the right answer. But now that I'm writing about topics that I'm passionate about, I love to write. And I think it's one of the most powerful ways to get my thoughts out there and understand things better. But anyway, that's kind of where my mind comes from. And so I always was attracted to spreadsheets and loved kind of puzzles and putting things together. So underwriting and finance generally is just such an awesome application of puzzles and math. And that's what really attracted me to underwriting.
Okay, cool. So one of the things that I'm really, really excited to talk about is to get your perspective as a finance person, right? As a finance guy, to get your perspective on how the market is evolving or how it has evolved to date. So from March to present, and how are you changing your underwriting guidelines, or how have your guidelines changed to reflect the risk associated in today's market, right? So what does that look like? We're going to get into this, man. We're going to make this a very unique discussion because there aren't very many people that can have a discussion like this. And frankly, this is where a lot of the value is created when you're actually acquiring a property, right? Because you don't want to just look for the upside. You have to understand how to manage your downside risk. So we're going to talk about that because risk in this market is either going to get priced appropriately or people are going to misprice risk, whether it be timing or when they're acquiring, and it's going to create some problems, right? So can you touch on that a little bit?
Yeah, definitely lots to talk about there. And I was actually just giving some advice to a friend who's looking to get some experience as an analyst. And I was explaining that, an average analyst is simply going to be able to show you what the numbers look like and kind of uncover the situation. But a great analyst is somebody who's actually going to provide insight into the business plan and help shape the business plan and identify where the opportunity is as far as the upside, like you said, as well as where you can find ways to protect the downside. So definitely lots to go off there. But going back to your first question, you talked about the evolution from March to today, as well as how we've changed our underwriting. So it's a very interesting world, to say the least. And just to kind of set the stage, back in March, the coronavirus pandemic began. And at that time, we don't have to get too specific, but let's just say cap rates on average were somewhere around 5%. And interest rates on multifamily permanent financing was somewhere around 4%. So there's about a 1% spread in your cap rate and your cost of debt.
Sure.
And that's actually pretty thin, right? Typically, you'd want to see somewhere between 200 to 250 bips especially if you're buying in more of like a secondary market, which is what we focus on. So pricing was tight, and now interest rates have dropped to 3%, let's just say. And so now we actually have a 2% spread between our cap rate and our cost of debt. So it's really interesting because everybody's looking for sellers to take discounts and the COVID discount and things like that. And we're really not seeing much of it. It's maybe here and there with pockets. But what's interesting is the cost of debt has gotten so much cheaper that really, without looking at the other fundamental changes in the market, actually multifamily has gotten cheaper because of your cost of capital has gone down. Now, if you start factoring in the unknown risks in the market in terms of the durability of your cash flows, are my tenants going to pay me? Are we going to have a nasty recession where I have lots of unemployment, I can't collect on my rents, I have to lower rents, higher vacancy? That's obviously going to hurt valuation. But for now, what we've seen is pricing has stayed stable, but your spread between your cap rate and your cost of debt has gotten more favorable. So really, if you're willing to take a risk today, there are some opportunities to be had, but I think it's all in the underwriting of the downside protection, as you said.
Okay, so let me elaborate on that, right? Because I can see that. And so I want to play devil's advocate as an investor, okay? So say I'm an institutional investor, you're presenting to me the scenario that you just spoke of, right? And so one of the things that I would be looking at, I'd say, okay, well, I understand that debt is cheaper now, okay? But what I really want to understand is what is the risk now associated with the income stream that I'm actually paying for, right? So how are you valuing that income stream? So if someone were to approach me and they said, hey, John, this deal is still worth $20 million based off of X, but even though we're coming into a market with a lot more uncertainty, my question would be, okay, well, I would say, okay, time out. Let's talk about how do we value that uncertainty and if that's priced in, right? So if you're saying that initially you're underwriting to a 5 cap and there are no adjustments being made to that cap rate, whether it's a 100 basis point increase or 200 basis point increase, even though we know there's a lot more uncertainty in the marketplace, how are you approaching that? Because I think that's what's creating the stalemate right now in the marketplace, right? So, but history loves to repeat itself because in 2008, 2009, 2010, and I think the difference is a lot more people have a lot more experience going through these markets. You had a lot of sellers that just waited and then got crushed, right? And so can you talk about that a little bit? How are you pricing for that uncertainty, especially when you're selling off to institutional investors because they understand this stuff, right?
They really do. And so going back to my previous point, I should make it more clear in the example. If everything stays the same, but your debt goes from 4% to 3%, now all of a sudden when you're bidding on a property, you're going to be able to afford to pay more. So actually your value would go up. That on one hand is bringing values up, but the question is now the income stream factors such as vacancy, future rent growth, things like that, how is that affecting value? And so as you're alluding to in the market, that's actually had a greater effect on valuation than the reduction in interest rates because we aren't seeing prices go up. We're seeing them flat, if not slightly down. And so to elaborate on that, the three main factors that we're focusing on in our underwriting is the going in vacancy rate, because we just want to assume that there's going to be a near-term decline in collections, an increase in vacancy, but that's all near term. We're still very positive long term, but we need to stress our going in vacancy, no rent growth for the first 12 to 24 months. And then we're also looking at a longer stabilization period. So those three factors are really important to focus on and actually have a huge impact on your underwriting. Stabilization timeline, because we might be going through a rough patch over the next period, higher going in vacancy rate, and then the no rent growth for the first 12, 24 months.
Okay, so let's talk about stabilization period, right? And let's get past the first 2 years because everybody is factoring zero rent growth for the first 2 years or zero for year one and minimal for year two. So what happens after that? Because typically, let's use your example, right? If I'm a larger operator or sponsor and I'm coming in and I'm making an acquisition, I can qualify for agency financing. So now I acquire this property, I'm going out to typically a 10-year term, amortize over 30 years. But what people don't talk about is what happens when that balloon comes due, right? Are you hopeful that your cap rate at exit is the right, you priced it appropriately? So in this market, how are you guys approaching that? Because let's say we're taking away 2 years of unknown. So after that 2 year mark, how are you approaching from year 3 up until exit, ideally year 9, right before that balloon comes due, right?
Right. And so one of the things I've been hearing from people is they're using no rent growth today for the next 12, 24 months, like we both agree. They're using that to then say, well, because we're doing that, we can then kick up rent growth thereafter to 3%, maybe 4% when it bounces back, because people are saying people are not going to do new development deals, so there's going to be less supply, and there's going to be some sort of rebound where rents shoot back up, and so they're using that as an argument to use a higher rent growth. We're not big fans of baking rent growth into our underwriting. We try to avoid it as much as we can because we really want to just see the deal stand on its own. But that is a reasonable argument to make. And I think another more macroeconomic argument would be that the Fed has proven itself capable and willing to support the economy with all its firepower. And so, don't bet against the Fed, as they say. And so my personal opinion is that we are going to not have a deflationary depression, but if anything, the risk is to the inflationary side. At some point, all of this monetary stimulus, fiscal stimulus, you just have to imagine it's going to result in some uptick in inflation. And so what that means, what is inflation? Inflation is just things get more expensive, including rents. So it's not unreasonable to imagine that all the money we're pumping into the economy today could result in higher rents or inflation across the board in 2, 3, 5 years down the road. Some people think this could even show up 10 years later. Nobody really knows. Inflation is one of the hardest things to really understand. But when it comes hard, and it's hard to stop. So it's definitely a big risk. But in terms of real estate's known as a great inflation hedge. And the reason why is because your income stream is largely inflation protected if you're collecting rents, whether it be from apartment tenants or from industrial tenants, office tenants, hotels, they change their rates daily. So if prices are going up, hotels can continuously increase their rates. So that's just another interesting macro wrinkle of inflation kicking up your future income. But obviously, if inflation happens, the 10-year treasury is going to increase, right? And then debt is going to increase. Cap rates must increase to maintain that spread. So if inflation kicks up to 2%, 3%, debt's going to want to be at 4 or 5%, and then the cap rate's going to be at 6, 7. I mean, that would be unbelievable. I have no idea what that would do to the market. How could the market withstand 7% cap rates? But
well, it's really interesting. We talk about that now, right? Like it's an anomaly, but you have to keep in mind that only 11 years ago, that was the norm, right? So I think one of the things that will be very interesting to see how this plays out is most people don't realize that 10 years ago, 11 years ago, we were in a 6.5% rate market, right? And so I'm going to use prime as just a talking point. Okay. That was normal. 10 years prior to that, 20 years prior to that, it was even higher. So I think one of the things that will be very interesting to see how this plays out is that one of the reasons why we are here today outside of COVID is, if you really think about it, rates have been declining predominantly because of the issues and the challenges that we dealt with in 2008, 2009, right? And so now we're compounding even more challenge on top of that. Okay, so with that said, I'm just giving a different perspective, okay? I'm going to talk about the P&L now, all right? And then we're going to go to the balance sheet. Okay, so let's talk about the P&L a little bit. So one of the things that I've learned over the years is the reason why we created a property management company to manage our own assets is we just didn't have a lot of success with third parties, right? We just did not, for a lot of different reasons. Not bad, not good. That's what it was for us, okay? So we made a conscious decision to create our own, okay? And I'm really glad that we did that. But now one of the advantages that came from that is it really gives us a frontline view into understanding what our operating cost truly looks like, right? Instead of having to rely on a third party. Not that that's bad, because you have a lot of tremendous operators out there, especially when you get into larger institutional level type assets, right? Now, that's not us. Okay, so I had to find a way to build a management company that worked for what we were buying and that we can infuse our cultures, right? Because it can be very difficult sometimes where as an acquisition company, you're building out one culture and you're also managing assets of that culture. But then you're engaging a property management company and they have a totally different motive, right? They're still trying to make a profit. Okay, they have a different culture. They have different requirements in order for them to do that. And so you have clash of cultures and clash of motivation. So with that said, I'm going to talk a little bit about the P&L because that's where a lot of those clashes show up, right? The clash of business cultures typically are going to show up in your P&L. Okay, so we've already made the assumptions around how you're underwriting the acquisition, right? But now let's talk about what are some of the elements of a P&L that you typically find that are underestimated when making an acquisition, right? So we're going to leave expense ratio out of this. We're going to talk about that a little bit later. But what are some of the things that you guys have learned to really hone in on when you're underwriting to an acquisition that you feel most buyers out there or savvy investors that they overlook?
Sure. So I think an interesting one is loss to lease. So it's sometimes easier to hide or to sell the potential upside as burning off loss to lease when really you're pushing rents higher and pushing market rents higher. So it just depends on how you're accounting for it, but it's really the same thing whether I increase rents by 5% or burn off loss to lease by 5%. I'm still pushing the effective rents at the property 5% higher, which is obviously not a given, not an automatic thing. But just to explain to everyone, the way that that could work is I own a property and I could just say that the market rent for my one bedrooms is $800, but really the in-place rent that my leases are being signed at is only $700. And I'll just represent the difference in a loss to lease. And I can make up any reason why I have that loss to lease. And then when I'm selling my property, I can just say, yeah, well, I'm a bad operator, but you buyer, you're a savvy operator. You'll just burn off the loss to lease, bring all the rents to market rate, and then, there's your value at upside. And so I think for us, we are very focused on obviously every piece of the income side, but we also look at the totality and say, okay, how much are we increasing the in-place revenue, right? Are we increasing it by 5%, 10%, 20, 40? And that has an implication to how much risk we're taking. If we're obviously moving at only 5%, we're going to consider that a core plus investment that's really more of a buy and hold turnkey. But if we're doubling the revenue, that's a whole ton of risk, and I'm going to want to be compensated with a pretty big IRR.
Okay, so let's talk about that because for some people that's going to sound counterintuitive, right? So elaborate on that a little bit when you talk about if there's more upside in rents, I want to be compensated for that additional risk. Okay, talk about that a little bit because it's going to seem counterintuitive, right? Hey, I find this great deal and I recognize that it's under market. There could be a lot of different reasons for that, right? Crummy operator, a lot of different reasons. Okay. In your case, you're saying, okay, well, look, we found this great opportunity. It's under market by roughly 30% in rents. We recognize it. Okay, we want to be able to ratchet this thing up, bring it to market, and at some point sell it off. I want to be compensated for this additional risk. Talk about that a little bit.
Yeah, I think that's a great point that you're bringing up because investors get sold on the before and after pictures. They'll see the shiny pitch deck with the classic looking kitchen and then with the after picture with the stainless steel and the granite and the USB plugs, and that before and after picture is such an easy thing to visualize and say, oh, of course, this deal makes a ton of sense.
Sorry, man, I loved how you ran that analogy. Go ahead. I've never heard anyone quite play up USB plugs.
Oh, well, they're value add.
Go ahead, man.
So yeah, it's a really easy thing for an investor to visualize and see that's value, that's a good business plan, that makes sense. And then they can sort of, the sponsor is let off the hook as to whether or not they're buying at an appropriate cap rate, they're solving for an appropriate return on cost and things of that nature. And so like we were discussing, if I'm going to and go through the business plan of, let's say in-place rents are 600, but I've got the plan to bring them to 800, that could require re-tenanting the property with a different type of tenant base. And that is a marketing effort. And obviously there's a lot of construction involved. So what we generally call that is business plan execution risk. So the more I have to do to earn my return, the more I should be paid for in case. So it's not just because I'm greedy and want a high return. It's because I need to be compensated for my risk in case it doesn't work out. if I don't hit the $800 mark and it only is actually $700, meaning my analysis was wrong, or the market changed on me, or my costs were higher than I expected, I need to know that instead of that 20 IRR I was gunning for, now I'm going to get a 15, which is still doable. Or I was gunning for the 15 and I'm going to get a 10, which is still, I can live with that. And so that's the reason why we need to match the risk of the deal, including the business plan execution risk, to the goal return.
Sure. So, but here's the interesting question, right? How many investors that you present to outside of an institutional investor, because they have the data there, okay, whether it's Reese, CoStar, apartment data, whatever the data metrics are going to recognize that kind of delta, right? Not very many investors are going to be able to recognize a big delta like that and say, you know what, there's a pretty big spread here. There's probably a pretty good reason for that. That likely means that there's more risk built into this deal or that I should be aware of. How do you approach that with your investor base? Maybe let me change the question. How do you guys price for that internally is the better question, right?
Okay. So the way that we price for that internally is we keep an updated return matrix. And what we do is we basically define the basically class A, B, C type of property. The location, is it class A, B, C? Is it a primary, secondary, tertiary market? And then is it a corp? So we then break out business plans by Core Plus, which for people who aren't familiar with Core Plus, that's generally characterized by a longer term hold period, more of a cash flow play, and less of a rehab deal. So for us, Core Plus is only raising the revenue by a max of 10%. Value add is raising the revenue by about 20% up to.
But really quickly, over what time period though is that 10 to 20%? Is that over the 10-year projection? Go ahead.
No, it's because of the business plan, right? So without factoring any organic rent growth, it's just directly between in place revenue, and then I'm going to renovate, I'm going to lease up, I'm going to improve management, and then that's my business plan.
So in other words, that's the value add opportunity, right?
Exactly.
Okay,
exactly.
Got it. Quantified right. In terms of rent growth or rent
increase in revenue.
Yeah, increase in revenue. Okay.
So so we go from a spectrum, right? Core Plus, deep value add, and then all the way to opportunistic, right?
Sure.
Between all those different factors, we have a matrix that says, okay, if the deal is, let's just pick an example, it's in a secondary market in a B location and it's a value add deal, we assign a specific return that we're solving for, which might be a 16% IRR or 20% IRR, just depending on the profile of the deal. So that's how we internally price for the risk, essentially.
Okay, now you're pricing that risk for the purposes of raising capital, right?
Yeah.
Okay, so if I take that out, this is where it gets interesting, right? When we're using our own money, okay? When you take out how you price for external capital and say now you're using your own money, how does that change?
Interesting question. I mean, the simple answer I'd want to say is it doesn't, but I know you want to push for the more interesting answer here, so I'm going to try to think of something.
I like that, man. Go ahead.
So what I will say is, generally speaking, unless we're talking to, like you mentioned, more sophisticated investors have a harder time judging risk, and they're more absolute return investors rather than relative investors. So meaning if in their mind, what's going to make them pull their money out of the stock market or out of their bank account, whatever it is, and invest in a multifamily syndication is if it's a projected 16% return to them, for example. And they don't really care how you get to that 16. Are you getting there through a 2000 vintage A location Core Plus deal, or are you getting there through a C location 1960s rehab deal, right? They're more risk blind and just solving for that absolute return. Just give me my return, and I don't really understand or care about the rest.
Right.
So me, because I see behind the curtain and see what's going on, for me, I would say that matrix becomes doubly important. And I'm at a time like today, I'm going to be far less inclined to take risk and scoop myself way more into that top left of our matrix, which is, nicer area, nicer deal, less risk business plan. So that's kind of my personal view on it.
Okay, so let me give you another perspective, okay? I'm going to give you a perspective from someone that's placing their own money into deals. That's me, 100% of my own money, okay? The way that I look at a lot of this stuff, okay, like I said, when you take out raising money from third parties, okay, or private investors or institutional investors, when it's just my money, I make it really simple. It's return on my time, my energy, and my money, in that order, literally. So, for example, if I looked at your business plan, okay, because it was a great example, right? You called it business plan risk. I go, man, that's actually, I like that. That makes a lot of sense. But that doesn't mean very much to a lot of people, right? But the way that I've learned to quantify that, since I'm the operator, okay, usually 90% of the time, even when we're venturing with other companies, it's okay, let's use your 5% analogy earlier, okay, with a 3.5% cost of debt. Okay, that's roughly now 1.5% margin. Okay. So if my money is going out and I know that my opportunity cost of capital is probably somewhere like 20%, because at minimum, I can take that same amount of money, lend it through a broker that's lending that money out at 10%, 9%, secured by a first deed of trust, okay, with very little effort, and I'm in a very good secure position, right? So I know that that's my starting point. So if I'm not getting at least a 9% yield on my money, I pass, okay, or a 10% yield on my money, I pass. All right, so that's the starting point, right? So now the question is, okay, this met the minimum requirement. Okay, so let me think about this. How much time am I going to spend getting to my target return? Okay, how much energy is that going to take from all the other opportunities that I could be pursuing? Okay, and then lastly, what does that translate into? Your point, you use an internal rate of return number. What does that look like afterwards, right? Because here's the reality. If I go chase a deal, okay, that's say a $10 million acquisition, and I'm competing with other companies out there that have balance sheets much larger than mine, not a very good use of time or energy, right? It's just not for a 5% cap rate, unless there's maybe like some major inefficiencies in that building or with that property that could drive yield much higher. Okay, but usually that stuff gets competed away pretty quickly unless it's off market and there's just some problems with that property, right? So I would prefer to spend my time finding problems to solve that I can justify getting a return on my time, energy, and money, right? And so one of the reasons why investors work with me, okay, and we built a reputation for doing this is they know that that's what I'm really good at. And I'm putting my money in every single deal. Okay. And most people, I think, unless you put your money in deals, it's very difficult to develop that kind of mindset because you're missing the ability to price your own time, energy, and money. You can't. Okay. It's very difficult to do that. Okay. But when your money's in the deal, now you have to look at a bag of opportunities very differently, right? I'll give you a really quick example that I just closed on literally 5 days ago, I think it was. Okay. I had a broker call me. We have a small property, 20 unit property in an area. Bought this property 10 years ago, very profitable deal, right? It's like 20% leverage. Okay. Then we have a row of homes right next to it that I've seen for quite some time since we own this little asset. Okay. And I can't remember what happened, but the broker actually reached out to us asking us if we had an interest in buying these 3 homes, okay, on an acre right across the street from this asset that we already own, okay? So garden style apartment building on roughly 2 acres. Now next door, this is roughly on, I think, an acre and a half, okay? So here's the thing. The first reaction, and this was my first reaction, you know what, man, I really appreciate you calling, but I don't think it's going to make a lot of sense because it's very small, right? Well, then the guy called back and said, hey, guess what? The person that we have in escrow now, they're going to fall out. And fortunately, I knew that area really, really well. And I said, okay, well, what's the issue? And the issue was most of those homes were built in the 1920s and they had a bunch of foundational problems, right? So anyways, the point there being is we end up coming to terms. I end up buying that property. I did what I call a reverse cash out. I'm not going to explain that here. But the point there being is I bought that with 100% leverage, got a great price on it, got a private loan for 140% of the purchase price, included all my improvements, right? Okay, small little property. It may not make a lot of sense when you first think about it, but then time, energy, and resources, right? So now I'm going to show you the numbers, okay? So tiny little property, okay? I think, let's see, we should make about 30 grand a year on that net after our cost of debt, okay? Then we're going to fix that with a 30-year fixed rate product, right? So the reality is I did put cash up front, but I'm going to get all that back once we refinance. Small little deal, right? Net 30 grand a year on it. The value creation from that was $500,000 in 30 days. Okay. Now, most people would immediately discount a deal like that, right? And here's the reality. No retail buyer in that market is going to spend $500,000 on that deal. And if I tell myself that they're doing that, I'm totally kidding myself. Not going to happen. However, okay, when I finish the improvements and I add it to our portfolio across the street and I sell it with that package, guess what? I just added $500,000 of value to that deal, right? In 30 days. That's what I mean. So when your own money's going out at stuff, okay, and you start looking at deals differently because you have to start pricing things very differently. Traditionally, would I have chased that? No way in this world. But in a couple of minutes, 2-3 minutes, you can do the math and say, you know what, there's a way to make this work. And if I can get all this done in 30 days, extremely profitable. And I create a $30,000 income stream with very little effort and energy, right? So the net effect was I took my investor money and I took them from an 8% yield to something like a 10% yield, not including the benefit that we were creating for us as operators as well. So I just wanted to give you that because I hear people talk about it all the time, but when your own money's in deals, it's really hard to look at things differently and to figure out how to create opportunity, right? So hopefully that makes sense.
Yeah, it makes plenty of sense. It's a very interesting thought, and actually something that we've thought about. We bought 300 units with all of our own money, and it just, the way that we run and think about that deal is completely different than a syndicated transaction. And it obviously makes sense. It's just different. And one of the interesting takeaways is, yeah, this deal requires our hands-on effort. And the reason why we wanted to invest all of our personal capital into it was because we saw such big upside, and that the upside was going to be created via our own sweat equity and really managing the construction in-house. We thought this return is great, and it is a great return, and it will be a great project. But the problem is, like you said, we didn't really factor in our time and our effort. And so how much is, let's just say arbitrarily now, say you had to give up a year of your life to work on this project. Let's just say, right? How much is that year worth to you? Like, is your salary 250,000? Is it $500,000? Is it $1 million? So if you bake in your, construction management fee, which is effectively your year's salary, into a hypothetical deal, and you throw on another $500,000 into your capex budget as the salary that you should be paying yourself for all this time and effort, then what's the return? Is the deal still good with that $500,000 baked into the expenses? So that's a really interesting thought that you brought up, which I totally can relate to. Which I don't know how to then. I mean, it does correlate to syndications because we do also look at deals, and if it's not in a market that we already own in and it will require additional effort, it's not really like a bolt-on acquisition. We're going to want a bigger deal. If we're going to go to a new market, we'd prefer that deal to be 20 million, 40 million, right?
Oh, I totally get it. I wanted to use that as a simple analogy that most people, including myself, simply would not even consider unless I started looking at it from a time, energy, and money standpoint, right? Because if you can make $500,000 in 30 days, why wouldn't you? However, you wouldn't look at it that way unless you approach it with a different mindset, right?
Yeah.
So that's why I bring that up. Now, here's the downside in buying smaller projects, 50, 75, 30 units, right? 100 unit projects. The downside is you don't get the leverage when you're ratcheting up rents, right? You don't get the rent bump leverage. You just don't. But if you can find something that's below market, to your point, right? Using your analogy, then yeah, it makes sense. But, buying 200 units, 300 units, you just get more long-term leverage when you're bumping rents. But if you're not a good operator and you can't do that, I always ask myself, okay, well, where's the value?
And it's tough to find.
Really. Yeah. Okay, cool, man. So now let's move to the balance sheet, right? I always like playing devil's advocate. And so before I do that, though, I'm going to ask you this question because we just talked about this kind of this unique scenario, right? Completely different than what you would be doing to attract institutional money to your deals. Okay. And I get the fact that the acquisition fees are amazing. So I'm going to paint another picture now. Okay. And the picture is going to look like this. Okay. And it's really more of a question, right? It's one of the things that I always struggle with when I look at presentation. And I just looked at one today for an 88 unit project that I actually kind of like. But now the metrics don't make sense, but I can make them make sense, right? But here's the analogy and here's the question. Okay. Let's use a 7 unit multifamily asset. And then the other side of that, now let's use a 50 and 100 unit. 50 and 100 unit. So one deal you're syndicating, the other, say you're buying with no partners. The typical equity split, we're going to talk a little bit about the balance sheet now. A lot of what I see is 20-80 split, 30-70 split. What does your structure look like roughly so we can use it in this example?
Yeah, let's just use the typical 8% preferred return with a 70-30 split behind it.
Okay, cool. So investors coming in with 70% of the money, you folks are taking on 30% of the ownership as general partners for all the work, energy, effort, right? All that stuff, finding the deal, et cetera. Okay. Now, if you take 100 units and you divide it by 30, okay, you have a 1/3 interest in that property, technically 30 units. So this is where it's like you almost have to educate investors, right? Okay, well, are you really better off if you have capital and you're a great operator and you know how to underwrite? Are you really always better off acquiring 100 units with someone else's money, okay, or stepping in and purchasing a smaller property and owning 100% of that, okay, with your own? So that's the question.
Okay. Yeah, it's a complicated question, and I'll try to incorporate the most important facts. So typically, I'll just say that a 50-unit deal is, just generally speaking, likely to be better than a 100-unit deal. Just less competition, less savvy operators, more opportunity in that space. That's exactly why you built your own in-house management platform, because no decent third-party manager is really going to waste their time on a 50-unit deal collecting a $20,000 management fee a year. So that's why the only person that's going to give that asset that quality time and attention it deserves is you. So that's why, you're vertically integrated. So from that perspective, the 50-unit deal is very attractive. But if I'm a sponsor and I'm deploying my capital, really the most profitable way for me to build my business is volume. And so I'm much better off, if I have $1 million, I'm much better off pulling off $100,000 for 10 100-unit deals that I can build a portfolio with my investors than I am to then go take that $1 million and use that as a down payment for my own personal 100-unit deal. Because as you know, I'll collect fees along the way, I'll scale my portfolio, I'll bring in asset management fees, and I've got to promote interest across the whole portfolios. And then you've got the requisite scale to really build out an infrastructure of accounting, in-house management platform, regional manager. So for me, that's my take.
Okay, cool. And I really appreciate that. And there's no right or wrong, right? It's about perspective. And that's why I'm asking the questions this way, so that our audience can see things from the lens that you and I are making decisions against, right? I mean, I think it's extraordinarily valuable to be able to give people various perspectives, but from the viewpoint of how people are actually doing business. So I really appreciate that. And I think the commentary makes a lot of sense. And there's no right or wrong. It just is. And there are different ways of doing business, which I really, really appreciate. So I'm going to ask you now, we're getting towards the end of the show, but maybe talk about one of your most profitable deals that you can share with us around the structure that you just discussed and what made that so profitable, especially with how you're underwriting, probably not to date because it was likely a project that you purchased and sold in the past. But can you tell the story of that project, what made it so profitable, and what decisions went into the acquisition you felt that actually allowed that asset to perform that way that it did?
Yeah, so a profitable deal we did was one where it was one of our first deals we partnered on. So we weren't the lead sponsor. We partnered with a local operator who was buying a very small deal, to the point, I believe it was a 48-unit deal or something like that, in a very tertiary market. So what really got us going on the deal and excited about it is it just really stood out by the numbers. It was being bought at about I think an in-place somewhere between an 8 and 9 cap. And I mean, that's just incredible. It's being leveraged by, I think, 4.5% debt. So the cash flow there was tremendous. And the structure that the GP had set up was a 70-30 split with investors and no preferred return. So that's a pretty expensive structure for investors, but because the deal had so much yield, it really supported it. Right. And so we came in on the GP side for providing, I think it was, somewhere around 90% of the equity as a capital partner. In exchange, we got a piece of the GP, which that GP side is, really profitable because there was no preferred return, like I said, and we got 30% of the cash flow. So from that perspective, the deal checked out by the numbers. And then at that point, it was just about checking out, okay, does the business plan make sense? Do we trust the sponsor? Do we like working with him and things like that? And our most recent success with the deal was being able to take advantage of the, current low interest rate environment. I think a few months ago, we refied, basically a refi that was, the loan proceeds were greater than the purchase price that we paid for the property. We could have returned all capital back to investors and then continue to cash flow at a tremendous rate. But we chose to only return half of the original invested capital, keep the other half, and then do more renovations to, raise the value of the property, raise rents, and continue to grow the income stream.
So what made that deal so profitable? If you had to boil that down into one, thing that you could point out, what made it so profitable?
Value add, right? And that's what everybody's looking for. But the thing about value add is it's really hard to find a deal that makes sense as it is and yet still has the value add component. So that deal had great returns, even if you didn't endeavor to go actually and renovate the units, increase rents, and perform the business plan, right? And so that's the unique part, which actually provided great returns as well as downside protection, because we knew that if we bought this deal and just sat there and did nothing, it would still have great cash flow. But not only did it have great in-place cash flow, we were able to go in there and raise rents to our pro forma, which was, maybe $100 or $150 above in place, and continue to create just more outsized value, not only just from the yield perspective, but now we've created value because we were able to, let's just say, increase NOI by 20%, and now the value of the property is increased by 20%.
Right. Awesome, man. Awesome. Well, Rob, you've been a tremendous guest. I want to thank you for being on. To me, I love this conversation because I don't always have an opportunity to get into the good stuff like this. So I really appreciate you being on and sharing your wisdom and your many years of acquisition experience. I think it's really neat. Any questions that you have for me that you feel that can add value to our audience? And then after this, I'm going to ask you to share with our audience how they can get in touch with you in the event that they have questions or, for that matter, want to explore some of your opportunities.
Yeah, I appreciate that. I can't remember if we talked about this on air, off air, but we were discussing my book. Would love to give your audience a shot at checking out my book on Amazon.
Please. I forgot. Yes, please. Talk about that.
Yeah, sure. The book is called The Definitive Guide to Underwriting Multifamily Acquisitions. Check it out on Amazon and, download the book or, buy the book, ebook, paperback. And once you have the book, you can also head over to lonestarcapgroup.com to download the underwriting model that goes with the book. So it's really to get the most out of the book and the model, read the book step by step and follow along with the model and, grab a hypothetical deal or a real deal. There's an example deal in the folder once you get the download and you subscribe, all for free there. Just, pay for the book on Amazon.
Awesome, bud. I really appreciate you sharing that. Can you name the website one more time for the audience?
Yeah, it's lonestarcapgroup.com.
Okay, awesome. Any questions for me before we exit that you feel can add value to our audience?
Question for you. No, I really appreciate being on the show. I love that we were able to have a conversation and not just play 21 questions. I had a lot of fun.
Awesome, man. I did too. And I really appreciate you being willing to play out various perspectives, right? Because I think that's how you learn. That's how you grow, when you can see things from multiple vantage points. And so I've learned actually quite a bit from this conversation as well. So I really appreciate that. And I look forward to another conversation. Look forward to inviting you back on again and, sharing more of your successes, right? I mean, that's what business is all about. And you being part of our growing network of operators and investors that are committed to taking average apartment buildings and turning them into amazing communities. And for that, I want to thank you, and I will talk to you soon, ma'am.
Thanks so much.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.